You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Okay, let's unpack this. If you were watching the markets last week, you probably saw something pretty counterintuitive happen. The Federal Reserve, the FOMC, they delivered exactly what everyone expected, a 25 basis point rate cut. Now, textbook Macro 101 says rates go down, the currency, weakens.
Yeah.
But instead, the U.S. dollar surged, just ripped higher. It was a real paradox, a major head-scratcher for a lot of people.
Oh, absolutely. And it wasn't just a gentle rise. It was a sudden, almost violent recalibration of market expectations.
Yeah.
So our mission for this deep dive is really to isolate those nuanced signals the Fed sent out that actually triggered this big dollar move. We need to figure out why a rate cut was interpreted by the markets as, well, hawkish. And what that tells us about the Fed's real sort of long-term view on the U.S. economy versus, the rest of the world.
Right, because that setup is just crucial, isn't it? Leading into that FOMC meeting, the market seemed absolutely convinced of one thing. Positioning was incredibly dovish. And when we say dovish positioning, we mean traders were just aggressively betting against the dollar, selling it short. They weren't just banking on the one cut we got. They were positioned for the Fed to signal a deep, multi-year easing cycle was kicking off.
Exactly. The expectation was, okay, here comes the accommodation. A big green light for risk assets, a weaker dollar, the whole package. And that certainty, that really aggressive short positioning, it meant the market was kind of precariously balanced. If the Fed didn't deliver that full, deep easing narrative, well, disappointment was almost guaranteed to cause a really sharp reversal.
Okay, so let's look at what actually happened. The immediate action. The Fed delivered the 25 basis point cut, fully priced in, no surprise there. We also looked at the 2025 dot plot, that's the Fed's own forecast for rates, and it ticked down a bit, from 3.9% to 3.6%, which also seemed, largely in line with expectations. Everything seemed okay for a moment.
For a moment, yes. But here's where it gets really interesting and why that dollar roar really began. The disappointment, the hawkish signal. It wasn't really about the immediate cut or even 2025. It was the longer horizon, specifically 2026, that caused the major headache for those dollar shorts.
2026. Why specifically that year? What were traders looking for there?
Well, traders were essentially pricing in or hoping for the federal funds rate path to signal something closer to 3%, maybe even lower by late 2026. That would have really solidified the idea that, yes, a deep, aggressive easing cycle was truly underway. But the Fed's own projections, their dots for 2026, they only moved down modestly to 3.4%.
Wait, hang on. So the market was betting on maybe 3.0%, and the Fed came in signaling 3.4%? That's a 40 basis point difference, 2 years out. In the world of interest rate policy, that feels huge. It's a massive policy disagreement.
It is a huge disagreement. A 40 basis point gap like that signals a policy path substantially higher than what the market had priced in. And that single difference, really, was the clear, relative hawkish message. It forced traders to basically wake up and realize, okay, this isn't the start of that deep easing cycle we thought we were getting.
Okay. And that explains the really violent, reflexive reversal we saw then. Any tiny bit of dollar weakness right after the announcement just got wiped out instantly as everyone digested that broader message. This cut wasn't a pivot to easy money. It was framed more as precautionary insurance.
Yes, and Chair Powell's press conference was absolutely critical in cementing that narrative. He really went out of his way to frame this cut as proactive, taken from a position of economic strength, designed to guard against potential future softening in the labor market, not reacting to problems now. The key takeaway for you, the listener, is that this was absolutely not a reaction to current economic weakness.
Right. So it's like taking your car in for a minor checkup, even though it's running perfectly fine at highway speed, just in case. But if the economy's so strong, why cut at all? Why the need for insurance?
It's about insuring against a potential slowdown. But you're right. The underlying economic projections they released alongside the decision, they absolutely reinforce this message of strength, robust strength. They're not just, saying the economy's okay. Their numbers project real confidence.
Okay, let's drill down on those numbers then. What specific data points showed that optimism?
Well, look at their GDP projections. For 2025, 2026, and 2027, they were all revised higher. For instance, 2027 growth, they now see it at 1.9%. They also nudged their unemployment forecasts lower across that whole period. I mean, if the Fed is revising growth up and unemployment down, that's a pretty unambiguous signal of confidence in the U.S. expansion, right?
Yeah, definitely. And crucially, the inflation outlook must have supported this slow, measured pace, too. It wasn't like they expected inflation to just vanish.
Exactly. That sticky inflation profile is just critical to understanding their thinking. If you look at core PCE, their preferred measure, the median view holds at 3.1% in 2025. Okay, then it eases, but slowly, down to 2.6% in 2026. And get this, that 2026 forecast was actually raised from their previous 2.4% prediction.
Raised, wow. So they see inflation being even stickier than before out in 2026.
Right, and they don't even see inflation getting back to their target until sometime in 2028. So this combination, strong growth projections plus pretty persistent, sticky inflation, that's the logical reason why they delivered an insurance cut now. It firmly resisted giving that signal for the deep rate cutting path the market desperately wanted.
Okay, that makes sense. The data just didn't support the deep cut narrative.
And what's really fascinating here is how this Fed message, this measured optimism about U.S. strength, immediately connects to the broader macro reality outside the U.S. Because the simple truth is very few other major G10 economies right now can boast anything like the momentum and resilience we're seeing in the United States.
So this idea of U.S. exceptionalism, the Fed sees it and it's showing up elsewhere.
Instantly. I mean, look at real-time trackers like the Atlanta Fed's GDP Now model. It's currently tracking Q3 growth, wait for it, an impressive 3.3%. That kind of underlying momentum just isn't visible in Europe or the UK right now.
Okay. And what about things like surprise indices? Are they showing this divergence too?
Oh, starkly. If you look at the City Economic Surprise Index for the U.S. that measures if data is beating or missing forecasts, it's been firmly positive since August. Analysts keep getting surprised by U.S. strength. Now, contrast that with the G10 ex-U.S. index. That's been steadily sinking. Data outside the U.S. keeps disappointing.
Wow, okay. So that gap, that real growth divergence, it provides a pretty solid rationale for the dollar's rebound then.
Absolutely. You've got solid U.S. growth, you've got inflation proving sticky, and you have a central bank explicitly saying, we're not rushing to cut rates deeply. That whole combination makes a bearish case for the dollar incredibly difficult to maintain. And it forced that rapid unwinding of all those massive dollar short bets we talked about earlier. It just squeezed them out.
Right. So looking ahead, it feels like all eyes are now on the incoming U.S. data to see if this growth inflation mix actually holds up, especially the August PCE report, right? That's the Fed's preferred inflation gauge.
Exactly. And we even got some guidance from Powell on that. He sort of signaled he expects headline PCE to land around 2.7% year over year for August, and core PCE around 2.9%. If those numbers come in near expectations, confirming this narrative of resilience and sticky inflation, well, the dollar strength likely has more room to run.
Okay. Now, this renewed dollar strength obviously put serious pressure on other major currencies last week. Sterling, the British pound, for instance, was one of the worst performers, wasn't it?
It really was. And that sterling weakness, it was almost entirely driven by intense fiscal stress in the UK. It's arguably worse than just the macro picture now. We got some pretty grim public sector borrowing data out. The government borrowed nearly $84 billion just between April and August. And crucially, that's about $10 to $11 billion more than their own official projections expected. That kind of fiscal overshoot, that hole, it immediately pushes up government borrowing costs, gilt yields, and really weighs on the pound.
Yeah, that puts the UK government in a really tough spot. Very limited, politically painful options, right? Either deep spending cuts or significant tax hikes. Neither sounds great for UK growth, and both are probably negative for sterling long term.
Exactly. And making things even more complicated is the UK inflation picture. It's actually expected to rise again, maybe towards 4% in September. That rise really limits the Bank of England's flexibility. They can't easily cut rates to help the economy when inflation is heading up and the fiscal situation is messy. You see it in market pricing, only about an 8% chance of a November cut priced in. So policymakers there feel pretty trapped.
Okay. What about other currencies? The Canadian dollar had a bit of a weird late rally.
Yeah, the CAD rally was a little puzzling, especially given Canada's generally soft growth and weaker labor market signals. The underlying macro picture there still seems to favor USD CAD higher over the medium term, despite that short-term move. Meanwhile, the New Zealand dollar, the Kiwi, got hammered, really underperformed after some dismal Q2 GDP data came out. NZD-USD dropped sharply, like 2.6%.
Right. And the euro, what's the outlook there?
Well, for the euro, we're expecting the upcoming September PMIs to show maybe a marginal improvement. The composite index is expected around 51.2. But even at that level, the growth signal is still structurally quite weak. Any softness there, or if the PMIs disappoint expectations, that will just immediately re-energize that dollar-positive U.S. growth divergence trade we've been talking about, the macro asymmetry, the balance of risks and potential. It just remains firmly in the U.S.'s favor right now.
Okay, makes sense. Now, before we wrap up with the final takeaway, we have to touch on one really unusual cross-asset move, gold. Despite this huge surge in the U.S. dollar, which normally crushes gold prices, the metal held incredibly firm, right? Trading near its all-time high around $3,700. What's going on there? Why is that typical relationship seemingly breaking down right now?
Yeah, that's a great question. Why is gold seemingly ignoring the dollar's usual gravitational pull? The main explanation, I think, lies in the real rate channel. We have to remember that rate cuts, even if they're shallower than maybe hoped for, are still on the table eventually.
Can you just quickly remind us what the real rate channel means?
Sure. So the real interest rate is basically the return you get on holding cash or safe bonds after you account for inflation, your real purchasing power return. Now, if the Fed is projecting sticky inflation, as we discussed, and they're signaling a patient, shallow cutting cycle, well, that implies that real interest rates might actually drift lower over time. And if the real return on holding safe, inflation-adjusted cash goes down, then non-yielding assets like gold start to look relatively more attractive.
Okay. So gold is finding support because the market still believes that future real rates are likely to fall, even if the dollar is strong right now because of the immediate growth divergence picture.
That seems to be the main driver. Gold also has had incredibly strong momentum, right? It's been running up for something like 8 months. However, that rapidly rising dollar does suggest that the immediate risk, the asymmetry for gold, is probably skewed more to the downside now. The dollar is just such a powerful macro anchor. That upcoming August PCE data, it matters for gold mainly through this real rate channel. If core inflation holds near that 2.9% level Powell hinted at, it reinforces that delicate balance. It suggests gold might be holding on partly due to momentum, but the risks are definitely rising if this dollar strength persists.
Okay, got it. So wrapping this all up, what does this mean for you, the listener, taking this deep dive with us?
The major conclusion seems to be that the market has fundamentally shifted its view. We've gone from expecting a deep, aggressive Fed easing cycle to now converging on the idea of a much shallower cutting cycle, much more patient. And the dollar's sharp rebound, it looks completely rational, grounded in, superior U.S. growth fundamentals, and also just the necessary clearing out of those huge, overly dovish short positions.
Exactly. The focus for the immediate future is pretty simple. Does the upcoming U.S. data hold up? We're talking final Q2 GDP, durable goods orders, and especially that August PCE inflation report. If U.S. growth stays resilient and inflation remains sticky, as the Fed seems to expect, then that positive bias for the dollar looks pretty locked in for now. Okay. And to leave you with one final thought, something that connects back to why the Fed is being so patient and resisted deeper cuts. It seems the Fed's own internal guidance actually implies they anticipate core PCE inflation might reaccelerate later this year, like moving towards roughly 0.27% month on month from September through December.
That's right. And significantly, they have explicitly cited tariffs as a likely, maybe even the major, driver of that potential reacceleration in inflation. So this forward-looking perspective, this idea that significant inflation headwinds might still be imminent, driven by trade policy, that seems to be the critical underlying reason the Fed is resisting deeper cuts right now. They're trying to strike a balance, offering a bit of insurance on growth today while keeping their powder dry, keeping rates higher for longer, potentially to fight expected tariff-driven inflation down the road. That, I think, is the real story behind their carefully crafted patience.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.